Hello everyone. In this video today, we're going to be going through the topic of the conventional or LCM, lower of cost or market, and cost retail inventory methods. Okay, this first page is relatively blank. It's just a couple of quick notes before we actually get into the problems. Okay, the best way to learn these problems is just to straight up do them. Talking about them a ton beforehand, they really don't make a ton of sense until you've actually seen them. And so we're just going to jump in just a second. The main thing about these problems is that you kind of need to watch the videos in a specific order. So there was a previous video that's basically the inventory basics for retail inventory method, and it has a chart in there that we're going to be relying upon a lot in this video. Okay, this is one of the areas in this class where there's a little bit of intuition behind what we're doing, but some of it is just kind of memorizing. A lot of it is just memorizing, kind of what we're doing here and kind of where the items go, whether they go above or below the cost to retail ratio line, okay, which we talked about in the previous video. And so we're going to be relying on the chart that I made to help us through these problems. The actual intuition of why stuff is included in the cost to retail ratio versus why it's not, there's not necessarily a ton of intuition there. It's just kind of what the FASB made up, okay? And so this is one area of the class where we do have to do a little bit of memorizing, okay? Just before we jump in, I just want to let you guys know. So conventional method, the main thing we want to note is the markups are above the line and the markdowns are below the line. And then for the cost method, markups and markdowns are both above the line. Okay, both above the line. Okay, so we just want to note that really quick. And now we're going to go ahead and jump into some problems. Okay, so let's just get this set up to where we can have, well, what we're going to most likely have to do is have this on one side, and then I'm just gonna have to read you guys. What's probably gonna work best is if I just have this along with the solution out, okay, which I'll get out in just a second, and then I'm just gonna basically go through the problem, and then, there's not necessarily gonna be a ton of intuition again, like I said, just because it's a little difficult, but everything here is on the chart. So if anything doesn't make sense, you just refer back to the chart. The chart I'm talking about is this one right here, just so everyone's familiar with it. Okay, it's from the packet, the basics packet for retail inventory method. Okay, unfortunately, there isn't enough room to have every single piece of paper on there, but we can at least have the facts and then the solution so we can see what's going on. Okay, now we're doing the conventional method. XYZ company is a retailing concern that sells a myriad of different items. The company uses the conventional retail inventory method to account for the cost of goods sold and the value of its ending inventory. As of December 31, the company has the following information available related to its inventory. Okay, then we're just given a bunch of items, we're given the cost of the items, and then we're given the retail value of the items. Okay, so it says required. Prepare a schedule to determine XYZ company's ending inventory and cost of goods sold for the year ended December 31, 2016 using the conventional retail inventory method. Okay, so what we're going to do now is that we're just going to lay our facts right next to our solution. We're going to make sure everything is in frame here so we can see everything pretty well. Okay, we should be able to see everything there, okay? So now we're just gonna go ahead and make our chart. So again, this is XYZ company, we're doing the conventional method. There's not necessarily like a three-part heading here as if it's like an income statement or something, but you might as well just label the chart what you're doing, right? Because we're making this schedule, okay? So again, we have a cost and we have a retail column, like we talked about in the video about the basics, right? So again, that's why it's very important to have seen that video before watching this one, because otherwise, everything we're doing here is just not going to make sense, okay? So basically what we do is we have our chart, and we're basically just going to transfer the information over to another schedule, but we're going to have to do a couple of things ourselves, right? We're going to have to transform this information in some ways, okay? The beginning inventory, you just move over. That's how it always is, okay? You just always move over the beginning inventory. So it's 40 for cost, 60 for retail. Purchases are 100 and then 135. We get that from the chart over here, okay? Freight in is down here at the bottom, and again, it's only in the cost column, okay? So we have it only in cost column here, okay? And again, all these items are listed in that chart. If there's ever a situation where you're not sure if it's supposed to go in one column or the other, or it's supposed to go above or below the line, every single one of these items is listed in that chart, okay? So you can go over that, okay? Purchase returns, well, let's see. Purchase returns are down here, 3,000 and 4,500, okay? They're right there. Purchase discounts are 2,000. Let's see, right here, purchase discounts, okay? So we've done all those lines. Then we have markups, okay? And like we said at the beginning, markups are above the line, okay? Markups are above the line. The line is right here. this is the line, okay? It's the cost to retail ratio line, okay? So markups are 5,000, and then markup cancellations are 2. Okay, so markups increase and markup cancellations decrease our retail inventory column, okay? Then we have abnormal spoilage. That one goes above the line. And we see here it's 4,000 and then 6,500. Okay, spoilage is, we're losing inventory, so that's decreasing the value of our inventory, right? So then we have goods available for sale at 146 and 196 for cost and retail respectively. Our cost to retail ratio there is 0.74. Okay, so if we took 146 and we divide by 196, we will get 0.74 rounded, right? It's like 0.744 or something, but we're just rounding it to 2 decimals. Okay, then markdowns, and again, like on the exam, like rounding, a lot of people, I'll just say this really quick, this is kind of a more general comment, but it just kind of popped in my head now. The rounding on the exam, okay, or a quiz or something, the professors and the TAs, they don't care that much unless they specifically tell you need to round to the 100th place or the 1,000th place or something like this on a decimal. They don't generally care that much as long as you're somewhere close, right? Unless you're doing something really weird with rounding. One time there was someone who it was like the decimal was like 0.145 and they rounded that to like 0.16. And at that point, like, that's such incorrect rounding that you're probably going to lose points for something like that, just because that's basic mathematics that you should know how to round, okay? It was something like this. You can't round all the way up to 0.16 there, right? Like, that's not right, okay? You need to make sure that when you are rounding, that you're doing it properly, okay? If you are rounding. If you're not rounding, that's probably best practice to not round, but just so we can keep the numbers a little bit more just aesthetically pleasing, I rounded it here. Markdowns, again, are below the line, so 4,000, and then markdown cancellations, they're right here. Markdown cancellations, markdowns, 4,000, and then 1,000. Sales revenue, okay, that's 9,000, and these are recorded gross, okay? So we'll take the 9,000 here, and then we have our sales returns, okay? Sales returns are 7,000, that decreases our actual sales revenue, so we're gonna subtract away 83,000. Here's a little bit of intuition here. Why are we subtracting away this 83,000? Well, if we're looking at retail value of goods, right, this sales revenue, the net sales revenue technically, because it's sales revenue minus sales returns, that basically kind of represents cost of goods sold on the revenue side, right? Like if we were to think of what's the equivalent of cost of goods sold in terms of revenue, that's sales revenue, right? Because if all these things are compiled at sales revenue amounts, then we have to subtract the actual sales revenue away to get basically an equivalent value for cost of goods sold, right? So that's kind of like something you can kind of think about there. And also, that's actually the sales value of it. So to get our ending inventory at retail prices, we have to subtract away the actual sales value, or else we will not end up with the same amount, right? Because if we were subtracting something like cost here, we would have some weird hybrid of things, because we have all retail items, all retail amounts, and then some random cost thing. This ending number would be something very strange, okay? Then we have normal spoilage for 6,000, which always goes below the line. It is right here, and it's only including the retail column. So if they give you both retail and also cost, then you just ignore the cost column, okay? Generally speaking, if you have like an extra item like listed here in cost column or something like this, or in the retail column somewhere, are you going to lose points? I mean, as long as it doesn't affect your final answer, you probably won't lose points, but it still is just best practice just to be safe. You might lose points. There's no guarantee that you won't. But, a lot of times I generally wouldn't take off points for that. But if the professor told me to, then I kind of had to. Okay. Then we're going to revisit one thing in a minute. But let's just finish out the problem. So then basically we have ending inventory at retail. We're going to multiply that by 0.744 or whatever. That's going to give us our ending inventory at cost. Then we're also supposed to solve for cost of goods sold. Cost of goods sold here would be beginning inventory of 40 at cost, right? Plus our purchases, which are 100,000, okay? That would be our purchases net, okay? Minus out the ending inventory, that will give us our cost of goods sold for the year, okay? So basically, this is purchases net, okay? This includes within it our purchases of 100,000, our freight in of 5,000, and then we have to subtract out the purchase returns and the purchase discounts, okay? That would be purchases net. That would be our actual net purchases, okay? And so it's not just the 100,000. It also includes these other items. It's just so they kind of cancel out, because freight in increases our purchases, but then purchase returns and purchase discounts actually decrease our purchases. And so that means that it's 100,000, okay? So our cost of goods sold 62,005 after we do this, and our ending inventory is right here. The only other thing to note is on our little chart here, we have these stars here next to employee discounts and sales discounts, okay? And so it says, if sales are recorded gross, these amounts are ignored. If sales are recorded net of discounts, we will use these amounts. Okay, we'll look at an example of this later. This is where we're looking at the example, okay? So it tells you in the problem that sales revenue is recorded gross. We see this on this line item here, right? And then it tells us that it's $90,000, okay? Then we see we have employee discounts, okay? On our previous page that we just looked at, it says, if the sales are recorded gross, as they are here, we ignore the amount of the employee discounts. We don't use it. So if we look at our solution, we've done that correctly. We ignore the employee discounts. Why do we ignore the employee discounts? Okay? What we're trying to do is we're trying to actually subtract out the full retail value of the goods because we've actually sold those goods, right? So, for instance, let's say we took this $90,000 and we subtract out this $1,500. Well, now we're only subtracting out $88,500. Right? Which is not the actual full retail value of the goods that is sold, right? That would basically shortchange us and say that we didn't sell $1,500 of goods. We actually did sell those goods. It's just that we didn't actually charge that sales revenue. We didn't charge that full amount to our employees because we're giving them a discount. We're cutting them a break, right? But so what we want to do is we always want to make sure that we're subtracting out this full amount of revenue at the gross amount. Now, if the problem said, okay, the sales revenue net of discounts is $88,500, then you need to subtract out $88,500, and then you need to subtract out $1,500 for the employee discount. Because at that point, the sales are no longer recorded gross, but we need to subtract out the full gross amount of sales revenue, or else we're going to basically understate the amount that's sold, right? And then we're going to overstate our ending inventory because we're not going to subtract out enough, okay? So basically, that's the way that works. And so that explains that star on the previous page. Okay, so that's the conventional method. Now we're going to flip over to the cost method, and this is going to be actually the same set of facts as our previous problem. It's just going to be, let's just get, the only thing that changes, so we'll be able to go through this one a little bit more quickly because we've kind of covered everything in the previous example. So basically, let's get everything set up here. Again, these are the exact same facts, so I'm not going to go through every single fact, but it's just this company, they sell a lot of products. They use the cost. So now we use the cost retail inventory method to account for cost of goods sold and the value of the company's ending inventory. And then as of December 31, 2016, they have the following information available. Again, if you were to flip back, this is literally the same chart. The only thing is now it's saying prepare a schedule to determine XYZ company's ending inventory and cost of goods sold for the year using the cost retail inventory method, not the conventional method anymore. Okay, so what we're going to see in this problem is only one thing is going to change, okay? And again, if you were to flip back, you would see only one thing is going to change. The one thing that's going to change is what we talked about on this first page right here, okay? In the cost method, markups and markdowns are both above the line versus conventional, markups are above the line, but markdowns are below the line. So literally what we're going to do is that we're going to take this same set of facts, we're going to make the exact same chart. The only thing we're going to do now is that markdowns and markdown cancellations are moved above the cost to retail ratio line. Okay, that changes our cost to retail ratio. Everything else in this problem is literally the same thing from the problem before. So we're not going to go through all that just because that's almost a waste of time, right? Like we're literally just saying the same thing again, beginning inventory, purchases, all that stuff, right? All that stuff is exactly the same. We can just be a little more efficient and say, okay, now this changes basically our goods available for sale at retail. It doesn't change our goods available for sale at cost because these items don't even factor into cost anyway, so there's nothing here, right? So that means our cost to retail ratio is a little bit different. It's 0.76 now, okay? Our ending inventory at retail is still going to be the same, right? Because we're still doing all the same calculations for retail by the time we get to the end. It's just the intermittent value, goods available for sale, cost to retail ratio changes. But we're still subtracting and adding all the same amounts. So then we'll multiply this by 0.76, whatever the decimal is. We get 78,674. Then if we do cost of goods sold, again, it's 40,000 plus 100,000 purchases net. Again, that's 100,000 plus 5 minus 3 minus 2 gives you 100,000. Then you subtract away ending inventory to give us 61,326 for a cost of goods sold. Okay, so again, this is just a basic equation. In case that wasn't clear before, this is just a basic equation for accounting. Cost of goods sold is equal to beginning inventory plus purchases minus ending inventory. Okay, that's how we can use that. That's why we can use that equation. But yeah, that's basically it for these two methods. This problem pretty much covers almost anything you could possibly see. There really are not many other variations that you could see like in many other items. And so that's why I made this problem the way I did and I went over the different variations too. I also went over, okay, if sales are recorded gross versus they're recorded net, okay, what do we do? And so, yeah, so that's basically the end of this lesson. There'll be one more video for the LIFO and then the dollar value LIFO retail methods. So, yeah, that's the end of this lesson.